goes and which way is the market headed. Let's welcome on board Anand Shah, CIO PMS and AIF at ICICI Prudential AMC to talk about exactly that. Anand, hi, good morning. Welcome to ET Now. Anand, what explains this kind of savage January that we're having?
Hi, very good morning and glad to be here. Uh, look, India has been a big underperformer last year, and to that extent, that continues. Last year was all about AI, and clearly by now everybody knows that India is a sort of an anti-AI play. So India underperformed markets like Korea and Taiwan significantly last year, and that also meant that FIs sold into India and bought into those markets, and that sort of continued. In the same breath, obviously the other trends also been sort of continuing, which is nowadays the favorite trade is also the precious metals, currency debasement, the tariff, negotiation slash uh, amendments and noise continues to be there. So that also gives a little bit of a fillip to risk off sort of an environment where the precious metals are being bought versus dollar versus other markets. So I think it's continuing from last year. Maybe it's sort of got accelerated in the month of January.
Right. Hi, Anand. This is Harsha. So we've tried to rationalize this. When does the tide turn? Is it flow related? So will a turn within the FII kind of buy sell number influence is maybe be the primary influence to Indian markets? Will it be earnings led? What are the triggers in your opinion?
Yeah, so clearly outside the global trends, there was also a trend within India, which was a strong slowdown in the earnings growth rate in 24, 25, and that sort of recovered gradually, but it's still fairly gradual. So we had a very strong 4 years of earnings growth rate in excess of 30, 35% CAGR, and that slowed down in FY25 and sort of has recovered in FY26, 27, 28 would be again expected to be a normalized 10 to 12% earnings growth rate, which will be in line with the nominal growth rate. But what we're saying this year will belong to more bottom up, more stock picking, and we are already seeing that even within India, domestic consumption play, you can see clearly there are companies within the sector also behaving differently. We're seeing that post the bank results. We're seeing how metals sort of outperforming where the value was always there. There were no triggers, and those triggers came through with rising non-ferrous prices and safeguard duty in ferrous prices. So I think this year will be earnings. Obviously, one element always remains the earnings recovery would take India back up into the limelight among the domestic and the foreign investors. But also it will be more bottom up. You'll have to be really digging deeper to identify businesses which are doing much better than the nominal GDP growth rate, which will remain a challenge this year.
Anand, but by the time news flow improves, these prices are not going to come back. Do you think right now is the time for a portfolio reset, perhaps?
Yeah, that's always an absolutely different question, and that always remains relevant, the timing in the market versus time in the market. So I think we've been doing that, and we continue to urge investors alike that, you maintain your discipline, whether it's a discipline of doing SIP, continue to do that, whether discipline of an asset allocation, the markets have sort of underperformed, other precious metals would have outperformed, the weights would have gone differently, so you can do those rebalancing also. So I think that's a separate question, and that continues to be the case, that the biggest opportunity in the markets are when there's no good news. So either you will have good price or you will have good news, and we believe when there is lack of good news, or better if there is more bad news, would be ideally the good time to invest into equities and vice versa.
But Anand, like you're saying, that it's not just about which equity. It's more about now how do you allocate within various asset classes as well, right? It's a multi-asset approach which has worked. Do you think that's going to be the case throughout the remainder of this year as well? Or do you sense that now perhaps could be the time to take a more concentrated and higher allocation towards equities per se?
So look, equity has always been, so in India, to be honest, we are overweight as a household, we are overweight real estate, we are overweight gold, followed by FD, and then followed by equity. So equity has never been a very large asset class, and luckily that's changing. It's an asset class which has delivered superior and sustainably superior returns to the investors. And through SIP and otherwise, the equity allocation for the Indian households is only increasing. So I think that trend need not change. That trend will continue, uh, and rightly so. If the precious metals are outperformed so much, you can take some money off those precious metals and increase allocation to equity. But again, as I said, it's a asset allocation, and that depends on individually to each one of the investors, and that's the decision to be taken by the advisor or investor himself or herself. But you're right. I think equity as an asset class has been, in the long run, delivered superior returns, especially superior post-tax returns. And to that extent, that remains the favorite asset class for us at least.
Anand, I wonder how you view the broader end of the market. It was your house which actually called out the fact that you believed that the broader end was overvalued. We've seen a 15-month correction, time, price, both. Uh, where does it sit at this juncture, in your opinion?
Indeed, that end is further more heterogeneous. It's more bottom up than even the large caps, and to that extent, I think we believe the opportunities have emerged, or they always existed, but they emerged more with the sharp underperformance in the last 12 to 15 months. And we are selective. We continuously looking at opportunities across market caps and identifying ideas. As again, I'm repeating, this year, identifying good businesses backed by solid management and to find them at reasonable valuations. That's been the challenge for last quite a while, last 24 months. The valuations have not corrected, even in the sharp underperformance that India had in calendar year 25. Uh, Look, India has not corrected very much. It's the other global markets which have gone up, and to that extent, India had almost 30% underperformance to other markets, which has been the sharpest since 1994. But that's also not because India has corrected; it's because the other markets have gone up. So I think valuations remains a challenge, and that's why going bottom up, identifying one company at a time is more important in this year than getting the broader market call right.
Where and what sectors within bottom up are you actually liking at this point? I know that you like financial services, for example. What within financial services, if you can just be a little more granular, and what are the other sectors? How are you playing consumption, for example?
So I think I'll come to financials, but within the consumption, the services part of the consumption is to us more attractive from a long-term perspective versus products. I think India has seen a fairly good penetration across consumer staples and other consumer products, be it paints and be it auto and other areas, especially two-wheelers. So we have seen the penetration game getting over. I think as per capita income goes up, uh, the incremental money is being spent more on services than consumption, which includes telecom, which includes entertainment, travel, restaurants, and so on and so forth. Even the way we are consuming goods is changing, where we moved from kirana store to modern trade to now more recently quick commerce and so on and so forth. So I think consumer services is one piece, and within that consumer services, the big piece is always in financial services. India is adopting more of mutual fund, more of wealth management, more of insurance products, and to that extent, within the financials, apart from banks, which we believe are in a very good shape. I'm speaking across spectrum. We'll have to do bottom up, but across spectrum, the banks have a very, very strong balance sheet, reasonably low risk as we speak today. In terms of credit cost, that is always the risk for the banks. But apart from banks, we like financial services across because that's the play where the adoption is making sure that they grow faster than the nominal GDP growth rate. And lastly, in manufacturing, which was been our favorite for last few years. We continue to remain bottom up, continue to nibble into them. Metals has been discussed so much, remains a large overweight position for us, and we continue to like that space given the valuation. The starting valuations were low before the rally, and even today, after the sharp rally on the back of rising commodity prices, the valuations are not overtly expensive, is what.
Interesting. Anand, I think equally important is to answer a question like what would you avoid in this market too sectorally?
So we've been underweight staples, as I said, consumer products, because the valuations are rich and the growth is fairly okay. It will benefit from GST, but there is a fragmentation. So there's more competition, more D2C brands, more new players entering that market. So overall, we believe the growth will be fairly subdued relative to the valuation that they trade. IT services is another sector where we've been cautious for a while. It has underperformed and bottom up, there will be a couple of ideas which might look interesting, but on a broader sense, relative to the valuations they trade and the risks that exist, especially on the back of AI, we remain sort of underweight in that sector as well. So these are the two large underweights which are funding our overweights in.
And Anand, how should one play auto in this environment? There is a case for a strong tailwind for growth. How are you playing that theme?
So again, that's one sector which has remained sort of complicated for us in particular. We've been seeing transition from ICE to EV. That's been the one big transition, and it will impact different players differently. Some of the players are benefiting, the incumbents, or some of the other weaker players might actually get impacted by that, both in two-wheelers and four-wheelers. That's one transition going through. The other transition, which is premiumization. So as the per capita increases and as the penetration increases, people are upgrading from two-wheelers to four-wheelers. People are upgrading from entry-level cars to SUVs. We have seen SUVs growing faster than the overall car segment and becoming one of the largest segments. So those are the transitions, and that has thrown up winners and losers. And we can clearly see how different auto companies have been performing differently over last decade, where some of them actually gained market share and outperformed significantly while others have been the laggard. So yeah, again, bottom up, there are opportunities there as well. We will also have some free trade agreements coming up, which will also pose newer challenges, if not opportunities, or maybe opportunities as well. But that's something also will impact this segment. So we're keeping a close eye and remain more bottom up
Here. Right. Okay, Anand, great to have you on ET now. Thanks as always for your time.
My pleasure.